Hello and welcome to this session in which we will dive deeper into analytical procedures. In the prior session, we looked at analytical procedures in general, and we stated that analytical procedures are evaluations of financial information through analysis of possible relationship among both financial and non-financial data, and we explained what that means. Also, we talked about the stages where we need to use or where analytical procedures are optional. And that's at the beginning of the audit, the use of analytical procedures is mandatory as a planning tool. We use at this point high-level aggregate data to pinpoint troubled areas and plan the audit and learn about the company. During the audit, remember this was an optional step, we only use analytical procedures as long as the relationship is plausible. There is kind of straightforward connection, for example, between debt and notes payable, between depreciation expense and fixed asset, and as long as the input, the data that we are using is reliable. And again, at this step, using analytical procedures is optional. And the third step at the end of the audit, the use again is mandatory. And here we are looking at the big pictures for obvious errors. And usually this step is done by senior, more experienced manager or a partner. Notice I'm going to state again that step 1 and step 2 are mandatory. So at the beginning of the audit and at the end of the audit, you have to use analytical procedures. Step 2 is optional. Now, why am I emphasizing this point? I'll tell you why. Because on the CPA exam, you might be able to eliminate 1 or 2 choices from the question just knowing that it's an optional step during the audit phase. So it's going to make your life much easier. In this session, what we need to do, we need to take a look at analytical procedure in context. What do we mean, look at analytical procedures in context? Every time you are using figures, numbers, ratios, balances, well, those figures don't make any sense unless you put them into context. Let me give you an example. If I told you your grade in my class is 80%, is this a good grade or not a good grade? Well, it all depends. If the average score was 95 for that test and you got 80%, well, that's not so good. If the average score was 65 and you got 80, well, now you have something to benchmark yourself against. Therefore, in this session, we're going to see how analytical procedures are used through benching. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Our audit course is best for online students and students who are struggling in their audit courses. We cover the essentials from audit reports, internal control, ethics, evidence, sampling, planning and materiality, assurance and non-assurance services, and of course, the accounting cycles. Our comprehensive course includes lectures, multiple choice, true-false questions. Go ahead and start your free trial today. We are here to help. Your success starts here. As I mentioned, the effectiveness of the audit evidence, especially analytical procedures, hinges on suitable benchmark data. So we have to look at something else. What can we look at? Auditors commonly match client balances and ratios against anticipated figures, what we anticipate, using various analytical procedures. What are we discussing here? There are few of them. We could use the client data and compare the client data to industry benchmark. We'll discuss this separately. We would look at comparable prior year figures. So we would look at your information this year to prior period figures. It could be a prior year, a prior quarter, something that's comparable within the same company. We could also look at client-generated expected outcomes. What are we looking at here? Budgets, comparing what happened to the budget. Or we could look at the client data and compare the client data to what do we expect to see as auditors, what we estimate as anticipated results. Well, we are smart enough to do that. We are smart enough, based on projection and forecast, to know what the numbers should look like given the current economic situation. Let's look at first, looking at the client data and comparing the client data to industry data. So let's take a look at these numbers just for the sake of illustration. So we have this company here, and we look at their inventory turnover. For year 1, it was 4.2, and year 2 was 4.4. So their inventory turnover is increasing, which is good. Their gross profit margin went from 28.4 to 28.5, practically stable. Actually, it went up. Let's look at the industry data. So far, if we look at this, it looks like the company is stable from year to year. Nothing unusual. That's normal. Inventory turnover, we're still selling inventory basically at the same level or a little bit faster, and our profit margin did not deteriorate, it did not improve, but it's hard to improve profit margin. Let's look at the industry. Their inventory turnover is 4.2 in X1, in X2 it's 5. Well, notice here now we're saying, hold on a second, their inventory turnover went up way more than what we did. In X1, we were matching the inventory turnover of the industry. In X2, well, overall, other companies are turning over their inventory faster. If we look at the gross profit margin for the industry, 28.4, also we were comparable. I use those numbers exactly the same. They don't have to be exactly the same. If our profit margin was 28.3, it would also be comparable. But let's take a look at X2. In X2, the industry, 30.01, their profit margin, this is a huge difference. Now, why did the profit margin overall in the industry improved substantially? That's a substantial improve, and we kind of stayed the same. Here we start to ask questions. You see how when we look at the client, everything looks stable. When we compare our performance to the industry, it didn't look as stable. So we have to find plausible explanation. So the company, as I mentioned, seem evident that it's showing no immediate signs of issues at the beginning, but when we look at the data, at the benchmark data, we should have suggested an expected increase at least in the gross profit margin. Okay? And what's worse, the industry is turning over their inventory. It means they're selling their inventory and making more profit. Why aren't we doing the same? Or is there a problem in how we account for inventory? It could be the problem, or it could be just we're not doing good. While these ratios may not independently signal major problems, they illustrate the value of using industry to assess performance and potential inaccuracies. What am I saying here? Well, this 4.4, we might have made a mistake here in computing inventory turnover. We could have made a mistake in cost of goods sold. We could have made a mistake in inventory. Same thing with the profit margin. If we made a mistake in cost of goods sold or inventory, it's going to affect profit margin. It could be, or it could be we're not doing good. I don't know. Possible explanation could be we are losing market share. That's possible. We're not being competitive anymore. Or there's pricing competitiveness. They're doing way better than us. We're still raising our prices and we're not selling. And no one buying from us, or our cost goes up, abnormal costs. Suddenly we have some abnormal cost. Maybe the machines break down and we had to have a major abnormal cost. It was part of cost of goods sold. Or it could be inventory obsolescence. Our inventory is going bad. We're not selling certain inventory. Or it could be recording errors, as I told you, that could be affecting the situation. It could be any of those. I'm not saying it's bad, but what we're saying is, let's look at this, something unusual. There's something unusual. Well, you could say maybe the industry is the problem. Well, it could be too, but most likely not, because the industry factors many companies, but we're not talking about the industry, we're talking about the client. So to ensure accurate financial statement, the auditor will have to make sure that number 4 and 5, which is inventory obsolescence, we have to revisit this, and recording errors might be affecting our figures. Might be. That's all we can say. And I hope through this simple illustration, you saw the value of what? You saw the value of benchmarking your data to the industry. Now, where do we get the industry data? So where did the industry data coming from? Well, there are companies that does this exactly, sells you the benchmark or industry data. Dun & Bradstreet, Standard & Poor's, they amass financial data for numerous firms in various industries, where CPA firms buy this industry data to establish expectation for financial ratios in their audit. So industry comparison offer crucial benefit. It helps you understand the client business. It helps you how well your client doing versus the industry. Again, that 80% that you got on my test, is that really good or not good? You really don't know unless you compare it to the class average. Predicting financial struggles. Well, if you are falling behind the industry, there must be a reason. Pinpointing potential inaccuracies, or it could be just a mistake in the numbers, because you should be doing as good as the industry or even better, and it could be a problem, not a problem, it could be a potential inaccuracy in the accounting information system. Now, bear in mind, there are limitations of industry data. Limitation means this is not perfect way to do things. Why? Can you think of some reasons why? I hope you can think of some. We're going to look at them. Significant challenges arise from contrasting specific client information to broad industry averages, which include many, many companies. There are differences in business nature and accounting method that hinder meaningful comparison. In the industry data, you could have small, large, medium-sized companies. You could also have different accounting method within companies, between companies. For example, one company uses FIFO, the other one uses LIFO. Some company use the completed contract method, another company uses the percentage of completion to account for revenues. So this is going to create different numbers. Depreciation method, another example. The use of estimates. Some companies are more aggressive than others, using various estimates. Nevertheless, industry data is still useful, but we have some time to make certain adjustments. To mitigate these constraints, one solution is to compare the client against the firms within the industry. So it's better if you have other firms within the industry rather than looking at the average. It's good to look at a company, your industry, your size. Then if you want to adjust for the accounting method, then you will adjust for the accounting method. Another way to look at data and analytical procedures is to compare the client data with similar prior period data. So you can take this year versus last year, quarter one this year versus quarter one year two, this quarter versus the prior quarter, whatever makes sense. And what you are looking for is something unusual. For example, if we're doing so, and let's assume we had a sudden drop in the gross profit percentage from around 29% that we've been experiencing for the past 5 years to 24. Well, that's a 5% increase in gross profit percentage. Well, this drop might stem from economic changes. That could be a legitimate problem that, we're not competitive anymore. There are more people who are competing with us in this industry. Therefore, our gross profit went down. Or it could be a financial statement error. Like what? It could be a cutoff error where we have some sales not recorded this period. Maybe we did not record certain sales. Maybe we overstated our accounts payable, which in turn overstated our inventory. It could be inventory costing discrepancies. Those are all possible explanations. All what we know is something is going on. Why did gross profit percentage drop? That's all what we are saying here. So the auditor must ascertain the reason for the decline to ensure accurate financial statements. Again, here's where the analytical procedures provide a way to compare the client data with previous period. And I told you this when I discussed the first analytical procedures. I know I'm going to say believe me, but believe me, okay? I hate to say the word believe me. When you work for a company, when you prepare the financial statement for a company, year after year or quarter after quarter, and I prepared a lot of financial statements, especially in form of reviews, where you study those financial ratios, immediately when there's something unusual, immediately you will be able to spot it. Analytical procedures is a very powerful tool. The only way to get better at this is to actually work in analytical procedures. All we can do in college and for the CPA exam is to teach you those techniques, but once you use them, they're very, very powerful. Okay, and when we compare the data, we would look at numbers. We're going to look at ratios and percentages. Let's take a look at more information, comparing client data with similar prior period data. So how do we do that? Well, we're going to look at balances. We're going to look at the balance. What's a balance? This is how much what's a balance? Something like this. You have year X2 and year X1. Those are 2 years, and you have cash. Last year was 100K. This year it's 115K. Okay? And we say, what does that mean? There was an increase in 15,000. That's all what we're saying in comparing balances. Looking at the balances, that's all what we're doing here. And things should stay stable or predictable. For example, if the company usually keep 100,000, that's what they like to keep every year in their cash account at hand, available at all time. Well, it could be 98,000, it could be 105. But if you saw that went from 100 to 60, you might be saying, hold on a second, what's going on here? Did they make a major purchase? Or are they did their sales go down? Are they consuming more cash than expected? Are they growing? Are they spending a lot of money? Or are they not generating sales? So things should say stable or predictable. By doing so, the auditor can readily contrast current and previous year balances. So once you learn about the company and you see the change in the balances and you understand them, you could immediately identify account warranting scrutiny due to notable balance shift. For example, supplies expense, it should not change that much. Account receivable from year to year, it should not change that much. Many accounts should not change much. And if they change, they should change in a predictable manner. For example, a 3% increase in sales or 5% increase in sales or 1% decrease in cost of goods sold from year to year. They should be predictable. Okay? For instance, if supplies significantly rose, the auditor should investigate whether, due to increase in usage, well, if supplies rose and there's an increase in usage, why? Are we doing more business? If we're doing more business, well, we should also see an increase in sales. Or otherwise, why not? Is it a classification error? We expense something as supplies expense. Maybe that's a problem. It's a misstatement in the supplies inventory. We expense some of the stuff. Okay. Now, bear in mind what we do when we compare balances. Yes, we're going to look at dollar amount. We also look at the size of the change. So, for example, I showed you the cash went up by 15,000. That's a 15% increase, which is 15,000 divided by, we'll take, I said 100,000 minus, the difference between year 1 and year 2 was 15,000. We'll take the 15,000 divided by the prior year. That's 15%. For example, the change was 15%. So that's also a major increase. So percentages is extremely important when we do analytical procedures. And you're going to learn about all sorts of ratios in this course. You're going to be familiar with all of them. Then we're going to apply different ratios in different cycles. Bear in mind, I'm giving you here is the big picture. So compute ratios and percent relationship when you compare with prior period. Why? Because if you compare only balances overlook the size, the business growth. What does that mean? Well, and also it overlooks decline or neglect data interrelationships. Let me show you an example. Let's assume, let's take a look at sales commission. I would rather use the sales commission as an example. So let's assume you're looking at year X2 and year X1. So you're comparing sales commission. So we're looking at the balances here, and I'm going to make it simple. In year 1, the sales commission were 10,000. In year 2, sales commission were 50,000. Wow, hold on a second. That's a 40,000 increase. It's not only 40,000 increase, it increases 5-folds, 500% increase. Wow, that's a major increase. Whether it's in dollar amount, it may not be that much, or it could be that much. But in terms of percentage, that's a 500% increase, or 5 times increase. There's something wrong here? Well, not at all. If your sales went from 1 million to 5 million, then, well, guess what? Sales commission should be in sync with sales. So if your sales went up by 5 times, your sales commission should go up by 5 times. Looking at the commission by itself at the balances, dollar and percentage, it might look scary. But when you look at it from a terms of sales commission to sales, yes, sales commission did go up. That's fine. Did sales went up as well by the same percentage or similar percentage? Now, also, if sales only went up 3 times to 3 million, then you might be saying, hold on a second, are we spending now? Maybe the company might say, we're trying to increase our sales, we're paying our commission more. That's fine. That could be a plausible explanation. But the point is, you have to know the relationship between the ratios. Same thing with bad debt expense. If we expect to have more sales on credit, we expect to have more bad debt expense. If we're selling to less worthy credit customers, we expect to have more bad debt expense, but we expect also to increase our sales. So you have to know the relationship between these accounts. And don't worry, we'll work exercises and CPA simulations. And again, we're going to work with these ratios within each cycle separately. Same thing if we are analyzing gross profit. When we analyze gross profit, we look at plausible explanation. Gross profit is an important figure. That's why I keep going to gross profit, because the gross profit involves cost of goods sold. It involves inventory. It involves sales. So it's going to affect many accounts. It involves accounts payable. So that's why gross profit is important to understand, and we'll look at it in a separate recording, how to compute it and what are the possible effects. What else can we do? We can compare the client data to budgets, to their own budget. We're looking at their numbers and looking what they budgeted. Auditors often compare client data with budgeted expectations to identify significant differences that could indicate also potential inaccuracies. If they expected their cost of goods sold to be 5 million and it's 7 million or 3 million, well, if that's what they expected, what's going on? There's a huge difference here. Well, if it's, the company should review that internally, but sometimes companies do. This practice is especially common when auditors are auditing governmental unit. Governmental unit, they live on budgets. Government live on budget. I have a whole governmental accounting course. It's all based on budget. So if you are auditing governmental unit, you would compare the performance to their budget, because that's like a main financial tool. However, auditors need to make sure that budgets are realistic and consider the possibility of data manipulation to align with the budget. Now, because there's a lot of politics that goes into budget. Sometimes companies, what they do, they under budget their sales, over budget their expenses. It's called budgeting slacks. You have to be aware of that. So you have to kind of look at budget with a grain of salt. What else can we do? We can compare the client data to our expectation. We are experts. As CPA, we know what to expect. We know how to forecast. We know how to project. And we can take a look at their data and say, this is what we expect. Then look to see how far are they from our expectation. Auditors often compare client data with expected results calculated by the auditors. We are the best analysts, right? This involves developing anticipated balances based on relationship with other account, historical trend, or non-financial data. For example, if their sales is increasing 5% for the past 5 years, we expect, and nothing have changed in the economic environment in that industry, we expect sales to increase 5% and we can predict what sales should be. That's what we mean by expectation. For instance, a hotel total room revenue might be projected by multiplying the room count by the average rate and occupancy rate. So if we're auditing a hotel, we can take how many rooms they have, what is their, on average, what's the occupancy rate if 80% is occupied, and they charge $100 or $200 per room, we can take the number of rooms times the average rate times the occupancy rate and project the revenue. Is it going to be accurate? We hope so. We hope it's going to come close to what they have. If it doesn't, we have to kind of explain or understand why not, because this is how you compute the revenue for a hotel. Similar method applied to various scenarios like estimating total tuition revenues for universities. If you know how many students they have, on average, how many courses they take, how many full-time versus part-time, you can project the tuition revenue. That's fine. You could also project factory payroll and material costs based on their production level. These procedures will help assess the reasonableness of recorded data. So it'll tell us whether it makes sense or not. For example, interest expense is very predictable. All we have to do is take the loan balances, multiply them by the interest rate, and you should have interest expense. Same when you compute depreciation. You should be able to compute depreciation and predict that number before looking at the company's number. So if your number looks different, you want to know why. Maybe you made a mistake, or maybe they made a mistake, but at least you have something that you are benchmarking against. Let's take a look at this multiple choice question. And that's the value of analytical procedures. It's going to give you a good picture about what's happening. Let's take a look at this multiple choice questions from Farhat lectures. Which of the following statement concerning analytical procedures is correct? That's easy because we have 1 correct, 3 incorrect. So if it's 3 incorrect, start with the ones that you could easily eliminate. Let's look at B. I don't like B. They are required during the testing phase of an audit. I don't like the word required. They are not required. They are optional during the testing phase. That's out. That's easy out. They are never performed during the testing phase. So let's look for those never must, those. They are never performed. No, they can be performed. They're optional. B and C are out immediately. So during the testing phase, you can use them as optional step. If you know that much, you're down to 50-50. Now we're down to 50-50. Let's take a look at this short one, because start with this one, especially if you're under pressure on the exam day. They normally use aggregated data at a high level during the planning phase. Yes, this is how you would use analytical procedures at the planning phase. You would look at the data from a high level. This looks like a good candidate, but let's look at D. Maybe we can find something wrong with D easily and eliminate D. They are performed during the planning stage That's fine. To assist in forming an opinion. Whoa. Opinion. No, opinion. That's done after we collect all the evidence. We base our opinion based on that, not when we perform analytical procedures at the planning phase. To form an opinion whether the financial statements as a whole are free from material error. Wow, that's so wrong. D is out. And as I mentioned, A is a good candidate. A indeed. Analytical procedures are used at a high level during the planning phase, and that's a mandatory step. What should you do now? Go to Farhat Lectures, look at additional MCQs. Whether you are a CPA exam candidate or an accounting student, invest in yourself. Good luck, study hard, and stay safe.